Welcome to today's video on how to stop losing money by investing idle cash in your retirement account. Thousands of investors leave large sums sitting in low-yield settlement funds, missing out on years of compounding. In this lesson, we'll demystify the confusing broker language like trade versus buy, and we'll walk through exactly how to move your cash into productive investments. We'll also share a simple portfolio strategy you can use today, plus show diagrams and flowcharts so it's easy to follow. Let's get started. Here's our roadmap. First, we'll discuss why leaving idle cash in your retirement account can be so costly over time. Next, we'll clarify the trade versus buy confusion that many brokerages create. Then, we'll walk through a practical, step-by-step workflow to move cash into your chosen fund. After that, we'll compare simple portfolio options like a total world ETF versus a three-fund approach. We'll also cover how to automate contributions and when to call support. We'll include quizzes to reinforce learning and finish with key takeaways and a specific action plan. Many investors unintentionally keep thousands of dollars in their retirement accounts, core settlement funds. These funds are designed to hold cash temporarily before you invest. While they're low risk, their yield is often far below long-term equity returns. Over years, the opportunity cost can be substantial. The good news is that moving from the settlement fund into a diversified investment is straightforward once you understand the process. In most retirement accounts, uninvested cash automatically sits in a core settlement fund, such as SPAXX. Think of this as a temporary parking spot for cash. It is not meant to be your long-term investment. The key move is to use the trading interface to purchase your target fund using the cash parked in the settlement fund. After the order is placed and settles, you'll hold shares of the fund inside your IRA, which positions your money to compound over time. Different brokerages label the order button differently. Some say trade instead of buy, even for mutual funds or ETFs. This is standard. Clicking trade simply initiates an order funded by your existing cash balance in the settlement fund. You are not replacing or reconfiguring the core position. You are using the cash that's stored there to acquire investment shares. Once you understand this, the process becomes straightforward. This flowchart maps the entire journey. You identify idle cash in your core settlement fund, then open the trade interface. Next, you select your desired fund, often a broad index fund or a total world ETF. You choose an amount, ideally using the available cash balance. Decision node checks whether you have enough cash. If not, you either add funds or reduce the order size. After reviewing and submitting, the trade executes, and the shares settle inside your IRA. The core fund remains your staging area for future deposits. Follow these practical steps. First, locate the uninvested cash in your core settlement fund, such as SPAXX. Next, from within the retirement account, click Trade. Search for your chosen investment. Perhaps a broad total market index fund, an international fund, or a single total world ETF. Enter the amount, often the full idle cash balance, if that aligns with your plan. Carefully review the symbol, the amount, and confirm the account type is your retirement account. Submit the order and wait for it to settle. Then, enable dividend reinvestment to automatically reinvest distributions. And consider setting up recurring contributions and automatic investments to stay consistent. Here we compare a total world ETF against a classic three-fund portfolio. A total world ETF offers extreme simplicity with a single ticker that provides broad global equity exposure. It is ideal for a set-and-forget approach. The three-fund portfolio provides more control by separating U.S. stocks, international stocks, and bonds. This flexibility allows you to manage risk and rebalance, but it requires more ongoing attention and decisions. This pie diagram illustrates two allocation approaches. The first view shows a single slice representing a total world ETF at 100%, emphasizing simplicity. The second view shows a sample three-fund allocation: 50% U.S. total market, 30% international, and 20% bonds. These are example proportions and not recommendations. The takeaway is to choose a level of complexity you can maintain consistently. This table distinguishes between the core settlement fund and investment funds. Settlement funds like SPAXX or VMFXX are highly liquid and function as a parking area for cash. Broad equity ETFs such as VT, VTI, or ITOT provide low-cost, intraday liquidity, and long-term growth potential. International ETFs like VXUS or IXUS add global diversification. Bond ETFs like BND or AGG offer stability and income. Expense ratios are typically low for these index funds, but always verify specifics. Quiz time. What does clicking trade typically do in your IRA? Option A. It changes your core settlement fund to a different money market. Option B. It sells your investments and moves everything to cash. Option C. It uses existing cash in your core fund to place an order for shares. Option D. It withdraws money from your bank to fund the purchase. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is, it uses existing cash in your core fund to place an order for shares. Clicking trade funds the order with cash already parked in the settlement fund. You are not replacing the core fund, and you are not withdrawing from your bank unless you explicitly initiate a transfer. Set up dividend reinvestment to automatically reinvest distributions back into your fund. Schedule recurring contributions to stay consistent, and use automatic investment features when available to pre-commit your cash to a plan. If you encounter any confusion, contact your brokerage support. They are trained to walk you through each step. Simplicity reduces decision fatigue, making it more likely you will stick to your strategy over the long term. This timeline contrasts two paths across a decade. In the first path, cash remains in the settlement fund, earning a low yield. In the second path, funds are invested in a broad equity index, with dividends reinvested. While markets fluctuate, compounding increases the potential value over time. The gap between invested and idle cash can become significant, illustrating why acting sooner can matter. Here are simple rules in Markdown format. First, minimalism wins. A single, globally diversified fund reduces the need to tinker. Turning on dividend reinvestment and scheduling recurring purchases allows compounding to operate on autopilot. Next, consider adding bonds as you approach retirement, or, if you prefer, lower volatility. Finally, rebalance annually, or when your allocations drift meaningfully. The overarching principle is that a simple, low-cost approach can be both effective and sustainable. This content is for educational purposes only and does not constitute financial, legal, or tax advice. Investing involves risk, including possible loss of principal. Past performance does not guarantee future results. Always do your own research and consider discussing your situation with a qualified fiduciary advisor before making investment decisions. Second quiz. For a hands-off investor who wants instant global diversification with minimal maintenance, which option best fits? Option A. A basket of sector-specific funds you rotate monthly. Option B. A single total world stock ETF. Option C. A complex mix of 12 regional ETFs. Option D. Keeping cash in the settlement fund for flexibility. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is a single total world stock ETF. It provides broad global exposure in one fund with minimal maintenance. This simplicity helps many investors stay consistent, which is often the most important factor in long-term success. This mind map organizes the set-and-forget approach. Start with contributions via recurring transfers and optional auto-invest. For the portfolio, choose either a total world ETF or a three-fund mix. Implement risk controls by adding bonds as needed and defining a simple rebalancing rule. Maintenance involves an annual checkup and keeping dividend reinvestment turned on. Finally, support includes using your broker's helpline and online resources when questions arise. These are the key takeaways. Idle cash erodes your future potential. Using trade to direct your cash into investments is standard practice. Simplicity is powerful. A total world ETF can be an effective set-and-forget solution. Automate whenever possible, including dividend reinvestment and recurring contributions, and maintain a periodic review cadence. If you get stuck, call support immediately so you don't postpone investing. To wrap up, open your IRA and identify any idle cash in the settlement fund. Use the trade interface to select a broad, low-cost fund. Consider using the full idle balance if that fits your plan. Turn on dividend reinvestment. Schedule recurring contributions, and then keep your approach simple. Consistency is key. Thanks for watching. If this video helped you turn idle cash into working capital for your future, please like the video, share it with someone who needs it, and subscribe for more straightforward investing guides. Tell us in the comments which fund you chose and what step you're taking today to get your cash invested. See you next time.